How long does it take to receive your pension payments once you finally cross the retirement finish line? It sounds like a simple question with a straightforward answer, but the reality catches thousands of retirees off guard every single year. You work hard for 30, 40, or 45 years, diligently contributing to your pension plan, assuming that the moment you clean out your desk, the money will naturally start flowing into your bank account like clockwork. Then reality sets in. You realize there is a massive difference between the day you stop working and the day your first pension deposit actually posts to your checking account. That gap, whether it's 3 weeks, 2 months, or even longer, is what financial planners call the retirement income gap. If you aren't prepared for it, it can turn what should be the most relaxing, celebrated transition of your life into a stressful waiting game filled with unexpected bills and shrinking savings. Let's break down the exact timeline of how long this process takes, why delays happen, and most importantly, what you need to do right now to make sure you aren't left stranded without a paycheck when you stop working. First, let's address the big question directly: how long does it actually take? On paper, most defined benefit pension plans, whether they are government pensions, military pensions, union plans, or corporate pensions, aim to issue your first payment within 30 to 90 days after your official retirement date. Notice that range, 30 to 90 days. That means, at best, you are looking at a full month without a paycheck, and at worst, 3 full months or longer. Why does it take so long? To understand the delay, you have to look at how pension systems operate. A pension administration team cannot fully process your final benefit amount until after your last day on the payroll. Up until your final day, your employer is still calculating your last paycheck, finalizing your accumulated and used sick leave or vacation time, and submitting final earnings data to the pension system. Your monthly pension payout is usually based on a complex formula that factors in your highest consecutive years of earnings, your total years of service, and your exact age on the day you retire. Because of this, the pension office cannot run the final, certified calculation until your employer officially closes out your payroll record. Once your employer submits those final numbers, the pension system enters what is known as the processing or audit phase. Human auditors have to review your work history, confirm service credits, verify beneficiary choices, check tax withholdings, and validate direct deposit details. If you worked for the same employer for 30 years without interruption, this process might move relatively fast. The good news is that this delay is almost entirely predictable, which means it is also entirely preventable if you take action ahead of time. The first actionable step you must take is to establish your timeline at least 6 to 12 months before your planned retirement date. Do not wait until 2 weeks before you hand in your resignation letter to contact your pension administrator. Reach out to your HR department or pension plan representative a full year in advance and request a retirement application packet. Ask them 2 specific questions. First, what is the current average processing time for new retirees? Second, does this plan offer interim payments, and if so, how long after my retirement date does the first interim payment arrive? Getting these answers straight from the source gives you the exact calendar blueprint you need. The second step is to complete a pre-retirement audit of your service records. 6 months before you stop working, request an official statement of service from your pension plan. Review every single line item. Check your hire date, your recorded years of service, your salary history, and your listed beneficiaries. If you notice an error, like a missing year where you took unpaid leave or an incorrect salary figure, you want to resolve that dispute while you are still working. Fixing a record discrepancy while you are still on the active payroll takes days. Fixing it after you've retired can stall your first pension payment by months. The third step is to build what financial planners call a retirement bridge fund. This is simply a dedicated cash reserve kept in a high-yield savings account, completely separate from your long-term investments. Your bridge fund should contain enough cash to cover at least 3 to 6 months of full living expenses. The purpose of this fund is to act as a buffer. When your regular paycheck stops, you draw from this cash pool to pay your day-to-day bills without stress, without touching your credit cards, and without stressing over the mail. When your pension finally kicks in, along with any back pay or retroactive interim adjustments, you can simply replenish your savings. Having this cash buffer transforms a potential financial crisis into a minor administrative waiting period. Fourth, pay close attention to your health insurance coverage during the transition. For many retirees, health insurance is tied directly to the pension system, with premiums automatically deducted from monthly pension checks. If your pension payments are delayed by 2 or 3 months, your automated health insurance deductions cannot occur. Finally, keep open lines of communication after you retire. Once your retirement date passes, log into your online pension portal or call your administrative counselor to confirm that your final payroll data was successfully transmitted by your former employer. Keep a paper trail of every document you submit, note the names of the representatives you speak with, and track the status of your file weekly until that first payment arrives. Retiring is one of the most rewarding milestones you will ever achieve. It represents decades of hard work, discipline, and commitment. Do not let administrative red tape or predictable processing lags overshadow what should be a joyful moment in your life. By understanding the 3-month timeline, auditing your records early, submitting flawless paperwork, and building a dedicated 3 to 6 month cash bridge fund, you can step into retirement with complete financial security, peace of mind, and total control over your future.